Hi, guys. So, we're going to talk about our chapter 5 in our 11th edition Advanced Accounting Redbook. And so, let me get off here real quick. I'm going to go ahead and start the slideshow. And so, this chapter talks about merchandise inventory. And so, it gives us a look at what we're doing here in the United States, what we have nationally, or what we have internationally, and then kind of how we figure it out. And then there are a couple of formulas and ratios that we look at when it comes to inventory. So, the first part is obviously the nature of merchandise inventory. Inventory is a huge cost to us. And so, the more it costs, the less money we're able to make. And that is a huge issue. Because remember, if we're not making money, we're not growing our business. And so we have our inventory methods, and we're going to talk about those. And these are all kind of just reviewing topics. A few things are new, but most of this is this stuff that we've already discussed in our accounting 1 and accounting 2. So we have a couple of um, issues that if we do make mistakes in our costing methods. So it definitely, if we overcost our merchandise, it's going to make the amount of money we make go that our income go down. If we undercost it, then it will inflate our income. And when we actually figure out that at the end of the year, we'll see a huge dramatic change in our income, and it can definitely um, overinflate that, and it'll create issues for us. So here's just an example that our ending inventory cost us $700. And so at the end of the year, our income was $900. But this other example, they actually they said our inventory only cost us $500, and so it ends up that our net income shows that we're actually making less. So everything is the same except our ending inventory. So then that means that our costs went up if our inventory isn't, and then we end up making less money. So here's an example of what they do. They show that kind of how it would affect if we overstated our cost of merchandise. Then you'll see that this is the amount, then our cost goes up. But everything else goes down. So if our gross profit goes down, our income goes down, our retained earnings goes down, our stockholders goes down, our inventory, our assets go down. Everything is affected when there's an error. And so this is why we try and make sure that we pick a good costing method that will work for our company. So remember, is perpetual, and then there is periodic inventory. Remember, perpetual is that constant. When you scan it, the inventory of the inventory in that business, it automatically deducts it from the inventory. And then that's our continuous, that's perpetual. And then your physical count, that's your periodic. So you do that once a year. You go count. I told you that story about the me being a teenager and getting a job at our local grocery store doing inventory, and for some reason they always put me in that baby aisle, and they have 3 foot deep shelves, and I have these short little arms that are big, and I would always break those bottles. So because I would be doing that physical count. So perpetual right here and periodic right there. So when it comes to shipping, and we see this, so think of Amazon, and when you buy something from Amazon, right? So if you have Amazon Prime, shipping is free, but you're paying extra for Amazon Prime. You're paying extra for Amazon Prime. So if you just have regular Amazon, you have to pay for shipping. So there's two different types of shipping when we call it FOB, which means free on board. And then we have FOB destination. So we have FOB shipping point and we have FOB destination. So here's a great model of that. So here is my vendor. So here's the vendor who we're buying from. Okay, so think of this as Amazon. And if I just have regular Amazon, I am FOB shipping point. I'm the one that pays for shipping. Buyer pays for shipping. Okay. FOB, oops, back. FOB shipping point. Okay. If I have Amazon Prime, I am FOB destination. Okay. I'm FOB destination. The vendor pays for the shipping. So I'm FOB destination with Amazon Prime. I'm FOB shipping point with regular Amazon. So just a little, example. I think that's the greatest example. It works fabulous for what we need. So here's another example of goods. We might have something called consignment. And I know those of us here in Mountain Home, we have a little store that's called a little consignment store. So you take your items there, the store then sells it for you. So it says the person or business that receives the good is the consignee. That would be the store, right? And then the person that gives the goods to the consignment is the consignor. Okay. So that happens. You have those consignment stores are like super little chic, and you can sell all kinds of things in those stores. So we have to keep track of our inventory. And so we generally keep track through a stock method for that perpetual inventory. So we're going to use a stock record or a stock ledger. Okay. So this is what it looks like. It's super simple. I love this thing. It has the description of it, the stock number, when to reorder. So this tells us we're going to have to reorder 60 at a time. It tells us when we need to reorder. So when we get down to 20, and then it tells us where it's located. So I always think of like bolts and stuff. Any kind of uh like big item, or when it says location bin 253, I think of Home Depot and Lowe's. So here it shows us our increases side. So when we reorder, it shows our decreases size when we sell, and then we have a balance column. So on October 1st, I had a beginning balance of 38. On October 22nd, I sold 20, so that dropped my inventory down. On the 31st, I ordered I sold another 10. So that left me with 8. Now remember, my minimum is 20. I should have ordered back here when it dropped to below 20 or at 18, but I didn't. I didn't order until November 5th, but I ordered my 60. That gave me an amount of 68. On the 14th, I sold 30 more. That dropped me down to 38. On the 9th, I sold 25 more. That dropped me down to 13. And so because I dropped below the 20 I ordered another 60, and that leaves me with 73. So it's super simple. The stock records, I think, is one of the easiest things that they have in these next couple of chapters. So for the physical, so that was the perpetual. So for the physical inventory, this is where, remember, we're touching it. We're doing it at the end of the year. So we have our list of what we have. Here it's under drill accessories. Under the description, notice there's different items. We have masonry bits on here. We have drill extensions on here. We have a grouter mix on here. It's not just an inventory record of the one item. So that's a huge difference, okay? So on here it says our number of units on hand, how much they cost us. Here are drill bits. We had 47 on hand. Well, 40 of them cost me $325. 7 of them cost me $320. So then there's my total cost. And then of course we have the grout mixer on here. And each one of them cost me $498 for a total cost of $239. So there's a big difference between this guy, which is just keeping track of the individual, right? The individual. And then this guy who is keeping track of all of the accessories. So you are so familiar with our next piece in here, and which is our inventory costing methods. So our LIFO, FIFO, and weighted average. So it's super important that the company decides which method is best for them. So are they a first in, first out type of company? Are they a last in, first out type of company? Or is it better if we just keep track of an average? And so those generally accepted accounting principles require that they have to use the same method every year. When you pick it, you have to stay with it. Now, can you change? Absolutely. You cannot change at the beginning of a year, though. I mean, at the end, in the middle of a year. If you decide to change your method, you have to put that information in a note in the forms that you send to the Securities and Exchange Commission, and then you have to reevaluate all of your inventory. So if you've used FIFO and then you decide that that FIFO method really isn't the right method you should be using, you should be using a LIFO method, you have to write that up and you have to explain why you're changing and how is that going to affect the cost of your inventory. You have to write it up, and then it has to be approved. Well, you have to write it up for the Securities and Exchange Commission, and because that is going to affect your stockholders and your valuation of your company. So it's extremely important that that this is why they want you to pick one and stick with it. So remember, those generally accepted accounting principles are what we call our GAAP, and then we have our first in, first out. So we did this. We've already done this before. So first in, first out means the items that are left are at the bottom. So the items that we're going to count are at the bottom. So there were 36 items, so we would take all 16 of the bottom, and then we would take what was left, which was 20 of the 24 at 1070. So this would give us our total units on hand and our cost for those. LIFO, that means last in, first out. So everything that we got in last, the end of the month, sold before the stuff at the beginning of the month. So we've talked about this. FIFO, think of milk, right? First in, first out. You want all that fresh milk to go out first because it has an expiration date on it. All that milk has an expiration date. Think of last in, first out as canned goods. They're stocked. They're supposed to, when you actually, if you have a good stocker, the stocker rotates your inventory. But a lot of people don't. They get we got a new box of green beans, let's put them on the shelf. And all of those green beans that have been sitting on the shelf already are now pushed to the back. And so all the newer green beans that are in the new cans are in the front. That's last in, first out. Okay? So think of it that way. And then of course you have your weighted average method. So you have to take all of your costs, you're going to average, then you're going to divide them by your total number of units you bought. That gives you your average, and then you multiply it by your number of units that you have left. So each one will give us a different amount at the end. So in this example, our first in, first out method was 386. This one was 346.40, and this one ended up as 367.20. So they all give us different method. So this is where we look at where it's best to select that inventory method. So down here, if prices are rising, they've talked about this, okay, and we'll talk about it here in just a second. If the prices of our products, the cost is rising, then our inventory is going to be high. The cost of our inventory is going to be high. The cost of our merchandise sold is going to be low, and our net income is going to be reported as the highest. Okay, so it's going to show that we're making more money. If we use the LIFO method, this is saying our reported income is going to be lower. It's going to be lowest. And if we use the intermediate, if we use the weighted average, it's going to be in the middle. Okay, this is saying we're going to see the highest amount of income, the lowest amount of income, and that one's going to sit somewhere in the middle. So when we talk about prices, we have to talk about inflation, and inflation is just the general increase in prices. So it says inflation impacts the cost of the ending inventory calculated using each of the inventory methods. So the higher the ending inventory, the lower the cost of merchandise sold, and vice versa. So the same thing applies when it comes to, so it says the rate of inflation is influenced by many economic factors. So starting into economics here. So it says FIFO method allows the business to report the highest level of income. The LIFO method would result in lower taxable income. So my income would go down, right? And a lower tax income liability. So what do you want? Do you want to record the highest amount of income? But if you make more money, then you pay more what? You pay more taxes. So you have to make a choice. Do I show that, yes, I'm making more money, but I'm also paying higher taxes? Or do I show I'm making a little bit less money, but I'm also paying less in taxes? So deflation results in that lower merchandise inventory cost. So we're going to look at it, what deflation, when the prices are decreasing, what it does. When we have deflation, the FIFO method reports the income as the lowest. It reports the income as the highest under LIFO. And of course, you have weighted average here somewhere in the middle. So LIFO, last in, first out, is really, it kind of moves around a lot. And so they don't really like, and this is why here in the United States, we want to reduce the amount of taxable income we have. So people in the US like that LIFO method. Unfortunately, internationally, no, it's a no-go. They don't like it. our international, so here in the United States, we have our GAAP rules, our generally accepted accounting principles. Well, internationally, we have what we call our international financial reporting standards, our IFRS. So they do not allow the LIFO method because they don't want that decrease in that tax liability. So the Security and Exchange Commission, it says, is committed to requiring publicly held corporations to submit financial statements prepared using IFRS rather than GAAP, because a lot of corporations that are traded internationally. So you have to follow those international laws. And international financial reporting standards do not allow LIFO. I hope that makes sense. So if they're a US only based corporation, they're not international, they could use LIFO if they wanted to. If they are if they are an international corporation, LIFO is a no-go. So you have your lower cost or market inventory costing method. It's we've done this before, but we haven't spent a lot of time on it. And it's basically just looking at which one is the best method that's going to give us the lowest cost. So here we put the cost here's our three costs right here. Here's our FIFO cost, our LIFO cost, and our weighted average. So the market inventory method costs our units, our inventory at the market price. So in this case, our market price is $10.15. Well, remember, on the other one, the market price was different at every single level. And so that means the market price of our units were $365.40. So over here, the lower of cost, right here, or market. So you pick which one is lower. So between 386 and 365, the 365 is the lowest. Between the 346 and the 365, the 346 is lowest. And the 367 to the 365, the 365 is lowest. So this is just looking at and picking which one is the lower of the cost or the market. So the last part is estimating the inventory. So based on our sales. So we're going to look at a couple of forms that we would be filling out. And we're going to look at what they call the gross profit method the first time. So here is one of these forms, gross profit forms. And so we have our inventory, our net purchases, our merchandise available for sale. We have our net sales to date, and we have our less estimated gross profit. So down here, we have our net sales times our gross profit percentage, and they told us that it was 48%. So then we have our estimated cost of merchandise sold, and then we have our estimated ending inventory. So this number comes from multiplying those net sales by this percentage. So this by that 48%. So that's how we get this number. Okay. And then this gives us an estimated ending inventory of how much it's going to cost us. The retail method is a little bit different. So this is how much it would be worth on the market at retail. That's why they call it at cost at retail. And then how much our net purchases, how much they would cost us. And then we have our sales to date. That gives us, we've added, we've subtracted. Now we have our estimated ending inventory, which is taking that inventory at retail right here and multiplying it by our percentage. So that gives us this number. So there are two ratios that we want to talk about. Our inventory turnover ratio. That means that when we buy it, how much inventory do we have to buy throughout the year? And then how many days does it sit in our building? So how many days does it sit? So the first one, that inventory ratio, talks about how many times we have to purchase inventory. So we add our beginning inventory and our ending inventory together. We're going to divide that by 2 to get our average. So this is on average how much inventory we have sitting in our building. Okay, this is how much. Then we take our cost of merchandise sold. This is how much our cost is. We divide it by the average, and we see our inventory turnover ratio of 5.84, which means basically we are turning over, we're selling and rebuying and selling and rebuying and selling and rebuying on average 5 times a year. 5 times a year. Okay, so we're buying this basically 5 times a year because this is how much our inventory has cost us. So now we have to figure out the number of days it sits in our building. So that's the days sales and inventory. So we take our number of days, 365, divide it by the inventory rate of turnover, 5.84, and basically our inventory sits in our warehouse no more than 63 days. So on average, 63 days. So we're buying and selling every 63 days about, what was it, $158,000 worth of merchandise. So those are the two ratios, and that is it for those for this chapter. So remember, we're looking at the different LIFO, FIFO, first in, first out, weighted average. We figured out how to keep track of the stock, and then those two little ratios at the end to how many times we're buying inventory and reselling it, and then how many days it sits in our warehouse. So that's it for chapter 5. Have a great day, guys, and we'll be off to chapter 6 soon.